Hi class, I wanted to go over project 2 and I just want to make let you know that project 2 is just a spreadsheet that you fill out and then upload. There's nothing to do with stock track on project 2. Okay, so let's go ahead and take a look now. Bear with me for a second. Okay, so this is our Canvas page, right? And if you scroll down to the investments trading projects here, we're going to go to project 2 right here. And so we'll click on project 2. And what you see here is a lot of directions. And there is a lot of stuff in here, and I could have easily made it 2 or 3 times as long with specific instructions. But I tried to make it short enough so that everyone would read it and you could retain it. But let's go through it step by step here together. So here are the 4 main things you have to do, and I'll give details below on each of those 4 things. Number 1 is you download and review the spreadsheet. The spreadsheet is what you have to fill out for the project. And then you're going to download and read this investment outlook report. It's published by probably, I think, the biggest money manager in the world, called BlackRock. In fact, they have offices in San Francisco, besides all other places around the world. And they have a specific division within BlackRock called their Investment Institute that publishes a kind of, I think it's a biannual, twice a year global kind of investment strategy report, and it has an investment horizon, I think, of a couple of years. I think it says it in here, but it's maybe like 5 years out kind of thing. It's not about day trading. It's not about putting together a portfolio that's set it and forget it for the next 30 years until you retire. It's somewhere in between day trading and a forever portfolio. It's like, it's like a approximately 5-year outlook. And this is the one from the middle of 2024. So we're obviously a couple months into it, but I don't think they're going to come out with a new one until the end of year 2024. And then using the BlackRock Investment Institute Mid-Year Global Outlook Report, you're going to design a portfolio. And you're going to give some justifications for how you design the portfolio. Those justifications should come from the Investment Outlook Report. And then the last thing you're going to do is just upload your spreadsheet to the report. So those are the 4 steps. And down below, we're going to go through a little bit more specific instructions, okay? So let's first off take a look at the spreadsheet, and you can click here, and I have it up already. I'm going to open it here, and let me make it a little bigger so it covers more of the screen. Okay, so this is project 2, and the first thing we're going to look at, and this is part of the kind of the portfolio planning process from an industry standpoint. And one of the things we didn't really cover yet was the first thing they often ask clients is about their goals and their constraints. So like, what do you want the money for, and how much money you're going to need in the future? and what things can you or can you not do. And based on that, they start the portfolio planning process. And the next part is they come up with economic expectations about all the things they can invest in the world. And that's what this report from BlackRock is. And so that first part, expectations, is what I want you to go to the BlackRock report and pull out what their expectations are for these 4 asset classes that I gave you. Okay, I gave you 4 asset classes, and you can see here we've got domestic equity, which is basically U.S. stocks, and then all foreign international equities I lumped into one category and just called it foreign equity. So everything from Europe, Asia, Africa, the Pacific, Antarctica, you name it, that's all foreign equity, okay? Anything outside the United States. Then we have bonds, and I just lump bonds all together into one category for the entire world, global. And then lastly, we have cash. And it's important to note for this that, remember when we first covered cash, we said really cash is kind of like not just like cash you have in your wallet or your purse or your checking account or your savings account. It can also include treasury bills. Any treasury with a maturity of less than a year is pretty much the same as cash. A money market account, which invests in very safe, short-term, fixed income securities like treasury bills, is the same as cash. Okay, so the report isn't going to tell you cash per se, but we're going to have to go and look, short-term, government securities. Okay, that's cash. So we'll take a look at that later. And then the first step here is for each of these categories, I want you to choose one of the following. Does the report from BlackRock say domestic equity is underperforming, average performance, or outperformance? And so you're just going to put a mark in the one that the report does. For foreign equities, does the report say under, average, or outperform? And they're going to give you tons of countries, and so you're going to have to kind of take an average of the different countries and kind of put one number down, okay? I'm putting an X here under underperform, but that's not what they said, but we'll take a look at it. Global bonds, just pick whatever the report says. I'm just selecting any number here. Don't take this as the answer, okay? And then same with cash. You have to pick one of the 3 categories that the BlackRock report is estimating for that asset class. Do they think it's going to do really well, or do they think it's going to do really poorly? Okay. And then in here, I want you to give the reasoning or what the report said. So try to give some specific wording that's in the report so I know that you went in there and you kind of read the report and you kind of understand it. Because, I'll be honest with you, being able to read this report, it's not easy. But, if we could say that you came out of this class and you could read an investment outlook report from a big investment company, I will be tickled happy. I think that's awesome, because just being able to read and understand, some of this high level stuff, I think is a pretty big accomplishment, and it would mean that you've understand the vocabulary that's used, and the asset classes and all that kind of stuff. So in a way, it's kind of like a good final exam. So that's the first part. Record expectations from the investment outlook. Okay. All right, let's look at the second part here. Now, the second part, you're going to design the asset allocation. And asset allocation basically means you're going to pick what percent of the portfolio you're going to put into each of the 4 asset categories, asset classes. So we have a total of 100%, and we're going to split it up between domestic equity, foreign equity, global bonds, and cash. So then the question is, okay, how do you decide? Well, there's no like exact answer, okay? But what we do have is I've given you kind of I've given you an average allocation based on an average expectation for an asset class. So let's suppose we're just looking at domestic equities here, right? And domestic equities, if we have an average performance expected, we should put 60% of our money in domestic equities. That's what that says. So if this was average up here under domestic equities, right? And domestic equity says here, this is 60% average, then our allocation should be 60%. Okay? If instead we said the report said that it's going to outperform domestic equities, it's not going to be average, it's going to outperform history, normal, then this should be somewhere between 60 and 85. So the better a category is going to do, the more we should invest in it. So then maybe we're going to put, this is where it's a gray area. There's no absolute right answer, but it should be more than 60% if we say domestic equities are going to outperform. Okay, it needs to be more than 60. So the same thing with foreign equities. We go up here and we look to see what we said the BlackRock report said. And here, if it says foreign equities are going to underperform, then we should put less than the average in. So I'm going to say, okay, it's 6%. Okay, so that's less than the average. It's not below the minimum, because we do have these minimum and maximum, and those are kind of like guardrails on a highway. You have to stay within these two boundaries, and that staying within those boundaries kind of forces us to build a reasonable, responsible portfolio that doesn't go to extremes and has us doing some really big bets where we think the asset classes are going to perform, but it's no guarantee. So we kind of have these guardrails to keep us from getting too crazy, basically. Global bonds here, right? If we said it was going to be average performance for global bonds, right, then we should put 30% here. Okay, and if we said cash was outperform, then we should put more than the average. So let's just say it's 5%. Okay. Oh, but now look, I've got more than 111% here. So I got to make this. I'm going to do some adjustments. I'm going to go back and forth a little so I get exactly 100%. So let me do some things. So first off, we said domestic equity is going to outperform. So let's try 65% here. Let's bring it down a little. And we said foreign equity is going to underperform. So I'm going to make this the minimum 5%. Okay. And then global bonds. Average is 30, and we got 30, so we can't really touch that. So I'm gonna have to make a couple more adjustments here, and so that's why I say it's kind of a gray area. We have guardrails, and so we kind of just have to make some adjustments to the portfolio. So let me try. Let's see. Let's make this 63%. We can't go lower than the 5. This is 30. We're going to keep it there because it's average performance. But this, let's make this 2%. And there we go. So now we've implemented this economic expectations in the asset allocation of our portfolio. So this isn't the solution, by the way. So don't like just jot this down what I did here. We're gonna have to go in the report and look, but this is how you would do it. So that's the asset allocation part. So we got that done. Security selection. Now sometimes I know people want to just like, hey, there's some stocks I think are a good deal, and I want to just go buy them. And I would say for project 1, that's great. Just do that in project 1. But for this project 2, I want you to use the investment outlook as justification for every security you pick. Okay? And the investment outlook will specifically state some industries. It won't always give you a specific company. Like, let me give you an example. The investment outlook might say retirement facilities, retirement long extended care facilities for retired people and stuff like that are going to have a really good growth. And they may not give you the name of a company. So then you might have to go look for stocks that that compete in that space for retirement facilities for seniors. Or they might say AI, artificial intelligence stocks are going to be doing really great. So then you should invest in some AI stocks. And you could either, maybe do some research, find some AI stocks and purchase those. If, however, the report doesn't give you any specific industries or companies, maybe it just says, like maybe under foreign equities, it says, hey, France is a really good investment and you should invest in France. And that's all they say. If they don't give you a specific industry or company to invest in, then you should find an exchange traded fund that invests in France. Okay, so if they don't give you direction on industry or a specific company, then just buy an index exchange traded fund that mimics that asset class. Okay? So, and I'm going to leave how much you buy of each security up to you in this report. But just remember that these totals here should be the same as the total up here. So if you say 63% in domestic equities, excuse me, then this should show 63% of your total portfolio. Okay? And then jot down here where you got the information from the investment outlook and why you chose it. It could just be the investment outlook said I should invest in France, therefore I bought a French ETF. Or it could be that the investment outlook said I should invest in AI, so maybe I found an AI ETF, or maybe I found NVIDIA. NVIDIA is like a big AI stock, so I invested in NVIDIA, something like that. But don't just like come up with some stock out of the blue that doesn't make sense from the standpoint of the investment outlook, because your job in this is to read, understand, and implement the investment outlook. This is not the time for, there's a little creativity here. I don't tell you which ETF to buy for the domestic equities. You have to pick that. But in terms of like going out with your own strategies, that's for project 1. This is project 2. It's read, understand, and implement a fairly high level investment outlook from a big deal company. Okay? So you're going to do all that here. And, cash, pretty much just find a money market fund or short-term treasury bills, less than a year, something like that. Probably an exchange traded fund, or an exchange traded fund of very short-term treasury bills. Or you could put, they don't have money market funds as ETFs. If you want a money market fund, you're going to have to pick a mutual fund. I'm not exactly sure why that is, but I'd have to think about that a little. But money market funds, it has to be a mutual fund. But there are ETFs that invest in treasury bills, which are the same as cash. Okay, so that's the spreadsheet. You're going to fill this whole thing out. Now let's take a look at, let's go ahead and take a look at that report. So we're right here, and now we're going to open up this report, okay? All right, here's the report. Pretty fancy. In fact, the picture on the front of the report is a little giveaway as to, some of the recommendations they're making on investment strategies. And if you look at this, it looks like a data center, doesn't it? Like all these rack computer systems put up. And so it does turn out, artificial intelligence is something that they've had in their last several of these global outlooks, because I've been using this for a while, and AI has been coming up for the last year or two, basically. So I'm not going to go through every line here, but I would suggest you read it. But I'm gonna see here they talk about mega forces. And so these are some of their investment strategies that they're going through. So I want you to kind of go through this and see what you can pull from it. Here it says, their AI theme is a 6 to 12 month view. Anyway, so let's see. They're talking a lot about different types of things that they're interested in, AI and stuff. Anyway, I'm not going to go through all those. That's kind of up to you to read through this and glean the information from it. But I'm going to give you kind of the final take here. If we go to the very end of this report, and it's talking about, infrastructure, all kinds of stuff. Demographics. You see, investment strategists, they look at a lot of information. They like Japan. So you probably want to have a Japan ETF. And look at this, hypothetical strategy allocation to Japan equities. You can either do a currency hedged one or an unhedged one. And so they talk about that a little. Let's see. Here they talk about, some of their big calls, and here they give the reasoning behind them. So that's a good source of information on here, right? Okay, this is I think the last page, and in a way this might be the money page. This is where we're going to get a lot of our final results or final recommendations, especially for asset allocation. So take a look at this. Here it lists equities, right? And here it lists United States. And check this out. They're at +1, right? And it says they're overweight. So they're putting a little bit more than their normal standard benchmark. And a lot of it is because of this AI investments that they think are pretty important. So that means, we would go here, right? And we would say outperform. And we would say the report said, AI is going to do really well. And don't do what I'm doing for word, but I'm just giving you an example. very bad English, gonna. um, and and corporate profits will improve due to lessening inflation, something like that. Okay. Oh, and you know what? It would be helpful. I wish I would have done this in the spreadsheet when I programmed it, but you should make it so I can read everything that you put in. Okay, so that's domestic equities. Outperform, and we gave it a reason why. And why don't we just stick with the 63% per now? I wouldn't mind going a little bigger than that, but for now, until we change these other categories, we're not going to change that. And then, what I could do here, let me just say, without going through it, let me say I'm going to buy some NVIDIA stock because it's AI, right? What do they call it? A mega force or something like that. And then let's say I'm going to buy an S&P 500 ETF. I don't have to put all my money in the mega force. It's good to have a diversified portfolio. I'm going to buy this VU, right? And let's say that's going to be now we don't want to put. I think if we go through here, you'll see. Let me see here. Excuse me for a second. And here, I've been talking through much of this, but here you can go ahead and read, words that go through what I've been talking about on this video. So don't put more than 5% in any one security, unless it's an ETF or a mutual fund, okay? And that's just like standard practice to reduce your risk. So when we go into here, into the spreadsheet, I would say, let's put 5% of our portfolio in NVIDIA, okay? And 5% out of $1 million is going to be something like 50,000, okay? And then let's say, I don't know, 58, right? We said 63 total percent, and that's going to be, I don't know, 580,000. Okay, and that's going to be U.S. stocks will do well. Diversified ETF, okay? And so we got 63% of our portfolio into domestic equities, right? And that's what we said we'd do. So we're good. So what I want you to do now is you're going to go through and do the rest of this for this report. So let's take a look at it. So now we've got so we have fixed income over on the right, and here we have equities. So here is the rest of all the international equities. We've got Europe, we've got UK listed separately, we've got Japan listed separately, we have emerging markets, and we have China. So what I want you to first do is, okay, if you group together all the foreign equity markets outside the US, is this report saying it's underperform, regular performance, or outperformance? Right? And when you think something is going to underperform, you invest less in it. And we call that underweight. We put less money. So like, see how Europe, it has a -1. So it says that we're underweight. UK is +1. Japan is a +2. Emerging markets are neutral and China is neutral. So if you were to look at all these 5 categories, these countries, and you took an average of them, what would it be? It looks to me it'd be somewhere around slightly positive, right? Because you got -1, +1, they cancel each other out. You got a neutral, and really it's just Japan at +2, so it's slightly positive, right? So that means what we're saying here is if we go up here, foreign equities, let's say it's outperformed, right? And then you give the reason why, what the report said right here, especially with like Japan and the UK, right? And then here you'd probably want to make this something like, 15% or 12%, something a little bit higher, right? Because now we're saying it's outperforming or performing better than average. And now we want to go pick some securities. So we definitely want, go through the report and see if they pick some specific industries or securities. Okay. But you may want, a Japan ETF. You may want a UK ETF, and maybe just a general international ETF, that covers everything pretty much. Any specific stocks that they mention or industries, check out the report and see what they say, okay? So don't invest any more than 5% in any one stock. You can do more in an ETF, but not in a stock. So that's your basic job, everybody. That's the project right there. And the last part, we've got global fixed income and cash. Okay, so what I want you to do is, I couldn't find cash specific, and I think let's go with this part as cash right here. It's the very top of the last page on the right side, short US Treasuries, and they give it a +1. So that's overweight, right? So that means when we go here, cash is going to be overweight, right? And so that means cash is going to have to be something positive, over 0. So we have that 2%. And then everything else here, from long US Treasuries all the way down to EM local currency, okay, all that stuff is going to be global fixed income. So take a look at that and see what it says. And when I look at this, I'm thinking it's, we got all these neutrals, a -2, a +1, and a -1. I would go with negative, underperforming in global. So I would go over and do this. So, well, maybe, and here you have to talk about what they say in the report, right? So that's what I got from here. Global bonds. Let's now make that 10% maybe, and looks like we can increase this now. Let's make cash 5%. Let's make foreign equity. Yeah, let's U.S. stocks. They like U.S. stocks, didn't they? Whoops. Let's make that 73. So you can see how it's a little give and take with the asset allocation. I know it's not scientific, but so there is a little creativity. All right, and then pick your securities. So let me know if you have any questions about this. But that is the overview of the project, everybody. I hope you like it. It is an interesting read. It may take you a couple times to read through it, and feel free to post any questions you have on the Ask Questions Here discussion board, or send me an email. And I will talk to you guys later. Have a good one. Bye-bye.